Hello, and welcome to the latest episode of the Friends of Sanctuary podcast. I'm Mary Ann Bartels, Chief Investment Strategist at Sanctuary Wealth. Today, I'm pleased to welcome our guest, Christopher Jensen, Vice President and Director of Digital Research at Franklin Templeton. Christopher, thank you so much for joining us today.
Thank you for having me. A pleasure to be here.
Our topic today is on digital assets, and it's one of my favorite topics, and I just have a passion for it. But why don't you start off telling us what you're doing at Franklin?
So I'm the Director of Digital Asset Research. Most of that research actually informs our investment processes. So I'm also a portfolio manager on our actively traded strategies. This involves a liquid token fund, as well as early stage blockchain venture. So, very much involved on the investment side. And then some of that research will get repurposed for external consumption and thought leadership in the space.
Franklin Templeton has really been a leader in blockchain and in crypto. Why don't you explain to our viewers and listeners what Franklin has done and looks to continue to do in this space?
Yeah, we've actually been in this space since 2018. And for a large asset manager, that's not crypto native, that is quite a long time. And it really started with thinking about the technology and researching it and asking the question, blockchains, are they going to be an opportunity for us as a firm and as an industry, or are they going to be a threat? So it really started off as a research project. And then from there, we wanted to actually try to use the technology. And so that's when we took one of our mutual funds, a money market fund, and figured out how to tokenize it and put it on chain and do so in a regulated fashion. So this involved, multiple years and I think over 80 discussions with regulators over those years to actually get it done. But we were one of the very first to tokenize the fund and have it fully operate on chain. So the official source of truth only exists on the blockchain. There's no, kind of duplicate records off chain.
Is it a token?
Yes, so we refer to the platform and the token and the project really as Benji. You can think of it as, Benjamin Franklin and, $100 bills, that sort of thing. A Benji token represents your ownership in that mutual fund. So what we did was we took the transfer agent function and completely brought that on chain. So again, how much Benji you own, that record is stored on the blockchain for everyone to see it, and that's the official source of truth.
And you can transact in that token 7 days a week, 24 hours a day?
Yeah, so one of the benefits of blockchains is it's always on, 24/7, 365, kind of functions like a dollar, but it earns interest, right? It's, treasury bills. And so what I can do is I can actually pay you, 5 Benji, a midday here, and the interest will actually travel with those coins, and you'll start accruing interest, the very next second. So instant settlement, 24/7. We have to know who you are. This is a security token, so we do KYC and AML. But other than that, we can freely transfer it amongst us and instant settlement.
Now, is this just for institutions, or can retail investors also have a Benji token?
Retail users can and do enjoy Benji. It's predominantly used for more institutional use cases. One of our most popular use cases is actually as collateral. So it will be collateral on an exchange, and various hedge fund type clients will post that collateral and borrow against it for their trading activities. So we found a strong product market fit there. But it's also used in retail and really used around the world now.
Your CEO, Jenny Johnson, she had a background at Franklin in technology before she became CEO, I believe. I've heard her talk about how moving to blockchain actually can save money. Mm-hmm. That part of going into blockchain, they found they could save a tremendous amount of money. Am I correct on that?
Absolutely. What's interesting is we actually ran it as a pilot program, and we did a kind of a test case of 50,000 transactions. And we ran those same 50,000 transactions the old-fashioned way on legacy rails, and 50,000 transactions on a blockchain. And what we found was, whereas it was like $1 a transaction the old-fashioned way, so $50,000, the total cost of those 50,000 transactions on a blockchain amounted to less than $2. So, what we love is it's not just a 10% improvement or a 20%, but really a step function unlock. And at first we thought maybe this was all just about cost savings, But what you also find is that when you use blockchains, they're programmable in nature. And so it actually unlocks use cases that weren't otherwise there before. I mentioned being able to transfer the interest and have the interest accrue immediately. That's something you can't do right on the legacy system. You usually have to wait till the night of for a batch process job, that sort of thing. Now it can all happen in real time.
So, why don't you, for our viewers and listeners, give them the basic 101s of what is blockchain and why is it called blockchain?
An easy way to think about it is blockchains are really just ledgers.
Like an accounting ledger.
Exactly. But one that is shared across a global network of computers. So you don't have one centralized intermediary saying, I have the source of truth. Everybody can see this source of truth on all these computers around the world, and they support this network. So when we think of a blockchain, we're thinking about information being appended to this ever-growing ledger. And the original
link by link,
block by block, link by link.
Hence blockchain.
Exactly.
Okay.
Exactly. So the original blockchain network was Bitcoin. And Bitcoin is really good at one thing particularly well, right? It keeps track of wallet addresses and how many Bitcoin are associated with that wallet address. So it's a very simple ledger, but very powerful and strong ledger. And then when you had newer blockchains, Ethereum might come to mind, or Solana, these used what we call smart contracts. And what you can think of there is it took this basic ledger and it made it programmable. So now you can actually do more than just keep track of wallets and balances. And that's what's really led to all these other interesting use cases.
When we started off with the internet, it was read only. And then we upgraded the internet and we could write on it. So we could read, write. Today, we could read, write, and own, and it's called Web 3.0. Most people, when I say Web 3.0, they look at me as if I have two heads. They have no idea what Web 3 is. But why don't you explain a little bit more in detail? I gave the simplicity of it.
Sure.
What is Web 3, and is it really important?
The key thing that Web 3.0 or blockchains are really enabling here is that it allows for digital property rights. So when we talk about the ownership economy, or when Sandy Call talks about the protocol economy, we're really talking about this evolution of the web, going from a read and write scenario where I can read a blog post, but I can also say on Facebook, or pick your favorite social platform, I can write and contribute, right? But I don't actually own that data, and I don't own a piece of that network. I could own shares in the equity of these big, tech giants. But with crypto and these networks that are created there on blockchains, by owning the token, so by owning, Ethereum, I'm actually owning a piece of that network and all the economic activity that happens on that network. These tokens can be used, there's utility value with them, and there's real ownership in these networks. And that is a fundamental shift. So what blockchains allow for is, digital property rights. I can own something outright, and we can prove that I own it by looking at the blockchain and that official source of truth.
And that's a Benji too.
Exactly.
Right?
Yep.
The other thing that I understand is blockchain has to be validated by more than one entity. It's not really a person. How many validations do you have to go through to validate that something has actually occurred on the blockchain?
This is what we mean by a shared ledger, right? So yeah, it isn't one firm having the ledger, but on all of that global network of computers, there's a copy of the ledger, and they're all validating transactions together. In Bitcoin, that's where they're doing large kind of computational puzzles or work, right, to kind of get the right to take that next block and append it to the blockchain. In other blockchains, they are putting up capital, and these kind of proof of stake networks is what we call. So really, it's an entire global network of computers and actors, market participants, all verifying and validating these transactions.
Now, I think you said there's a utility function. What do you mean by utility function? Because even I'm not sure I understand what that is.
Sure. So if we go back to our kind of mental model of this chain, and if I want to get one of my transactions, say we did the $5 Benji transfer, right? But we want to make sure there's a record of that. We need that transaction, that information included in the next block. In order to do that, we pay a little bit of the cryptocurrency associated with that chain. So if we're doing this on Solana, we would pay a little bit of Sol, the native coin of Solana, to get that block included in the blockchain. It's not just an investment thing that we're putting on a shelf or putting in a portfolio. We're actually using these cryptocurrencies, these tokens, and really they're fundamentally meant to be used.
Last year, there was the passage of the Genius Act.
Mhm.
And I think that has to do with stable coins. So why don't you explain now what a stable coin is?
You can think of it as a digital dollar, but one that is riding on these blockchain rails. So we talked about blockchains being 24/7, 365, always on, also global, permissionless. Well, this is a new set of infrastructure that we can conduct finance, and included in that is payments. So a stable coin is really just a token that keeps its value stable to a fiat currency. So, US dollars is the predominant one. So $1 is $1, right? And this is not a security token. And what the Genius Act allowed for is we finally have now a federal framework for thinking about these stable coins. And with that clarity, now institutions can have the confidence to participate in this. Because historically, people were using stablecoin payments really more for crypto native use cases. But now we're starting to see Stripe, Shopify, PayPal, Visa, all these companies kind of get involved because it's really, you can think of it as that evolution of payments infrastructure, right? And right now today, you can send a single dollar represented by a stablecoin anywhere in the world for under a second, for under a penny. So it really is kind of a 0 to 1, breakthrough, taking these blockchain rails and now stablecoins, which we have a regulatory framework for how to think about them, and send those stablecoins on these blockchains.
Now, are stable coins actually backed by US dollars?
Yes, and then the Genius Act also kind of mandated this for them to be Genius compliant. They have to be fully collateralized, so they are collateralized by
One for one?
treasuries. Yeah,
Dollar for dollar?
dollar for dollar, fully collateralized. So you could have a money market fund, traditional or a tokenized money market fund, like Benji, actually collateralizing and really giving that dollar, that stable coin, its support and ensuring that it's going to be pegged to $1 because we know that there's real assets backing it.
And who's the primary users of stable coins today?
More crypto native use cases, payments. Also, it is a lot of times the trading partner for other tokens. So if I'm buying Solana or Ethereum, a lot of times I'm buying them with a stable coin. So a lot of crypto native use cases, but we're starting to see it with small business, cross-border payments. People are thinking about, vendor finance, other use cases where we can involve this new type of technology.
One of the thesis I had, oh heavens, at least 10 years ago, is that the world was moving digital.
Yeah.
And is this a good example of how the world can move digital?
Absolutely. What's interesting, obviously, you can't really go anywhere without hearing or thinking about AI, the agentic economy. And, you and I, or who knows how many agents we're going to have, transacting on our behalf. They're probably going to be looking to use an internet native form of currency. And so we think stable coins and micro payments that are actually on blockchains, this is really going to be the form factor that agents are using, not just humans, but transacting on these blockchain rails as this world moves more digital, as you point out.
So that would tell me that the stable coin economy should grow over the next 3 to 5 years.
And it has. If we look at the chart of that, it does not look like the chart of, pick your favorite cryptocurrency coin, right? That is a pretty steady up and to the right, and we expect that trend to continue.
So let's learn a little bit more. You talked a little bit about Ethereum, Solana, there's XRP, and then they can have smart contracts. Let's define the difference between what a Bitcoin is and what all these other cryptos are, because I think that's important for people to understand because they really are different. What sets them apart?
We really think of Bitcoin as being a little bit different than these other assets. So Bitcoin, you can think of more as like a digital gold or store of value asset. It's obviously still in its adoption curve, but in a lot of ways, it is a form of kind of stateless money like gold. And so its role in a portfolio can be thought of as maybe having a similar function there.
And there's a limit to how much that can actually be created. correct?
Yes, the supply is known, it's programmatic, it's fixed, and so
21 million?
21 million total. Yep. So about 94% are currently in circulation. Every 4 years, we have this event called the halving, where new emissions are decreased in half. So you can think of it as this long asymptotic curve. So the supply schedule is known, right? And I think that's important. So we know the monetary policy of the Bitcoin network. So it's really a monetary asset. And you mentioned some of my favorites, Ethereum and Solana and the like. So those are the blockchain networks or the ecosystems. You can think of it as a set of rails where when you own those tokens, you are participating and owning a piece of all the economic activity that happens on these networks.
Let me see if we can say this, because sometimes it's really hard for investors to grasp this because
Sure.
it's not tangible, right?
Right.
Is this like a software program, a piece of technology that's sitting on the blockchain?
You can think of it as, especially these blockchain networks, it's really infrastructure. So when we talk about payment rails or something like that, this is a new set of rails, a new set of infrastructure in which we can conduct finance and other use cases. So then we can think about businesses that are built on this new set of infrastructure.
And is this the next stage of the internet?
Yeah,
Right? This
and
is
really
the
we're kind of
growing, right?
yeah, and we're really fleshing out what this new protocol economy looks like. You have blockchains at kind of the base layer. You have stable coins and tokenized money market funds, and you could have CBDCs. You have a liquidity layer on top of that. And then you have businesses that can build and plug into this new infrastructure.
So these are real businesses.
Real businesses, yeah,
I
solving.
think that's where people become really surprised that these are true businesses.
Yes, you have both. So some people are in it for the picks and shovels, the infrastructure layer, but then you have real businesses building on top of these. An entity that enables borrowing and lending or other type of financial activities, or
Like an XRP, Ripple.
yeah, so that is more of a payment coin and is looking to solve kind of cross-border use cases and that sort of thing. But exactly, so different companies engaging with this infrastructure and building on it to solve different use cases and in different markets.
I think where the confusion comes in, they call them cryptocurrencies. They're really not currencies per se. They have tokens, but they're not really currencies. Approximately how many exist today?
Millions and millions. So it's very easy to create a new one. And some of these things are not meant to be investable. They're really just meant to be used, or they're meant to be in a game. You can really create a token for pretty much anything, and so new ones are created all the time. When we think about digital assets as a new emerging asset class, that is a much smaller kind of subset of this total opportunity.
What are the
set.
largest ones today?
So the largest ones would be Bitcoin represents about 60% of the total crypto market cap. Ethereum is number two. You mentioned several of the big ones. Solana, you mentioned Ripple. So you do have a lot of these blockchain networks being represented in that top 10. But then you have more companies or applications like Uniswap that enables taking one currency or asset, digital asset, and swapping it with another in a decentralized way. So you can think of it like a Coinbase, but it fully exists on chain. It's just the software doing it. So that's an example of a business or an application built on this underlying layer.
Where do you think we are in the life cycle? Like, are we in inning 1 or 2 in terms of building out this new infrastructure, or are we later on in that stage?
I think, 2, 3, but I think the key thing to keep in mind, it's not a straight line. And a lot of experimentation has been done to date, really without any regulatory clarity. So I think right now we're at this interesting inflection point where, again, it won't, as we go through the innings, it won't be a straight line. We're really we believe we're about to hockey stick because of two things. One is more
You mean
regulatory.
go straight up, right?
One
A
is
hockey stick means
yeah, exactly.
yeah, okay.
Yeah, and just the rate of change and development, right? With added regulatory clarity, with more involvement from institutions, like our firm and others, we're really starting to, I think, accelerate adoption and really expand, the types of things that can be built on this new set of technology.
I think Congress still has a bill sitting around called the Clarity Act to get clarity. So what is the Clarity Act?
Yeah, so if Genius Act governs and provides a framework for thinking about stablecoins, you can think of Clarity Act as providing some of that clarity around the rest of kind of digital assets. So the very blockchain rails that these stablecoins travel on. To your point, it's a work in progress. It's right now in the Senate. I think this will be a key month to see what kind of progress can be done on it. We're cautiously optimistic and kind of constructive as we think about that. But
Been a little preoccupied with other things that are going on, I think.
yes. But this clarity really does help the market, and it helps really institutions have the confidence and builders to build and engage with this technology.
What I've heard is there's some friction between what I would call digital platforms
Hmm.
and banks.
Sure.
And that's why we're having this friction and we can't get this Clarity Act passed. Is there any color that you can give on what that is?
Yeah, it's basically an argument or a dispute, a discussion around these platform companies' ability to pay interest on the stable coins. Like Benji is an actual security. It generates yield, but a stable coin is not. It's backed by treasuries. It's backed by assets that are generating yield.
So those companies are getting the yield that are
Exactly.
holding.
Yeah, the stablecoin issuers, right? Someone's collecting it, right? And it's not being paid to customers. And so, really, it's a discussion over how should interest be thought of, treated, allocated with respect to stablecoins.
I'm assuming the banks are concerned that deposits will leave to go to stable coins if there's interest paid. I think that's part of the discussion.
Yeah, sure. You could imagine an argument along those lines. Sure.
Between Bitcoin, Solana, Coinbase, Ripple, XRP, there's Chainlink, there's so many others. Can you value any of these? And then if you can, how do you do that?
Yes, and so that's what I spend a lot of my time and my team does, thinking about these protocols, which ones are creating something of value, and is that sustainable? And as an investor in these digital assets, we basically have to get two bets right. One is that whatever this new company that's being built, that's going to generate value, right? And the second thing we have to get right is okay, that network generates value. How does it get back to the token? And because we want that price to go up for fundamental reasons, not just because of narrative or hype or speculation, right? And so with Bitcoin, again, more of a monetary asset, so we can put that one aside. We think of it more like gold. But for all of these others, we think of it as a technology asset. We look at it through the lens as if it were a business, even though a protocol is not a business per se. But we want to see customers and retention and revenues and what happens to those revenues. So we call this, a value accrual mechanism in the design of the protocol. And again, trying to figure out how value gets back to the token. So this is what we spend a lot of our time doing. And each one of these is a little nuanced. It takes, I think, best practices that we've all learned in traditional finance, as well as a lot of different kinds of diligence and data analytics that we're doing with on-chain data. As the industry and this space evolves, the information, the data quality has gotten better, and it enables us to kind of do our work and actually come up with price targets for these things.
Now, because these are so new,
Yeah.
they're extremely volatile. In fact, this asset class is more volatile than any other asset class that I've ever witnessed in my career. So these are not for risk-averse people.
Mhm.
But when you're looking to value, can you tell us any of the tokens that you currently are willing to own or to recommend?
There's good projects and there's good tokens, and ideally you want to find when they're paired up. I'll just use a name that most people know, Solana. It is a blockchain network that is one of the fastest and the cheapest. We're seeing stablecoin growth really kind of
On that platform.
really accelerate there.
And they compete with Ethereum, Solana.
They do, yeah, and we don't think one blockchain is going to rule the world, right? We see a world where there's multiple chains kind of coexisting.
So we're not going to wind up like with a single one, like most people use Microsoft, right? And use
Right.
Word and Excel. You think there's room for many players to exist in this ecosystem?
Sure, and we've even seen some of these chains or applications really specialize, focus on a particular end market or particular use case. Solana does a lot of trading activity, and it's really good for payments and other use cases. So we like that its economic activity on that network is diversified, fast, cheap. So we like that. And so what we can actually do is model all that economic growth. And remember when we said, what's the token used for and what's the utility? To get that transaction included on the chain, we have to burn a little bit of SOL, the token, right? We have to pay in SOL to get our transaction included. So we can start to add all those up and look at kind of trends over time and think about what is this network worth that everybody's kind of building on. So that's kind of how we think about it. And we use a lot of valuation methodologies, borrowed from traditional finance. So, we'll look at revenues and cash flows. We'll look at
So
comps and market
those are
multiples.
publicly available.
Oh yeah. One of the nice things about blockchain is, all the data is right there. It's just figuring out how to scrape it, parse it, make sure it's clean, organize it into a model. But nowadays you can flow this all in dynamically. Like we can look at, a model running off of yesterday's numbers. I don't have to wait for a 10Q or a 10K to come out.
Wow, that's absolutely fascinating. Now, I believe our president, Donald Trump, has his token and his wife, Melania, on the Solana chain. Am I correct?
Yeah, they launched, so again, there's all different types of digital assets and tokens, and this is why there are millions. So, there's a category called meme coins. They're more for fun or whatnot. So yes, they did. I think each launched their own kind of meme coin. Why did they do it on Solana? You could argue fastest, cheapest. That's where a lot of the other activity was, and so they wanted to kind of plug into that.
So can I create my own meme and put my token up on one of these?
You could,
in theory, if I wanted to,
you
could I
could,
do that?
I don't know exactly why you would want to.
Probably just to say that I have my own token.
you could absolutely
so I'm sure
do
it's
that.
going to have a utility function.
And I think though a key point not to gloss over here is that it is permissionless. So you can absolutely do that. Anybody can do that. And I can go build something that's fun and silly, or I could build, a real world, a payments infrastructure that's connecting to, third world countries, bringing banking to the masses. I mean, you could really do, kind of anything, right?
So before you invest in anything digital, you really need to do your homework. You have to know what you own, what that platform or smart contract does. So when you're looking to build a portfolio of digital assets, what are some of the roles that you think it can play in an individual portfolio? Should even individual investors even be considering this in their portfolio, especially considering their volatility?
We think of this as emerging financial infrastructure, right? And technology. And so I think, just like with stocks, sometimes it's hard to, single pick winners. I think there is a case to be made that, you want some exposure to this secular trend, right? It is volatile. There is cyclicality here, but there's something fundamentally happening. Like our financial system is in the process of being upgraded.
I think that is the most important statement that you've made. So I need you to repeat that. That was the key.
Yes. This secular trend, this transformation that's happening is our existing global financial system is being upgraded, in real time. And this is why you have announcements from NASDAQ and, New York Stock Exchange of how do we go 24/7? Well, maybe we should be using blockchains, taking assets.
Digitizing Wall Street.
Back to the theme that you mentioned of moving
We're
onto
moving
this
digital.
Yep, exactly.
I think what will help viewers and listeners and investors is if you have your money at a major bank, you already have your money on the blockchain. And I don't think people realize that. Can you kind of explain that money today, money that regular dollars that we have sitting in our banks are already on the blockchain?
Well, they're certainly on, ledgers, but a lot of times these ledgers aren't on, a public permissionless open blockchain.
It's a proprietary platform that they've built.
Right.
Correct?
Yes. And there's more kind of friction and whatnot with that. And so what's happening is, but all the banks, and the asset managers, we're all running programs and thinking about how we can do more on chain.
Because it's considered the most secure platform that we have today, blockchain.
And it's a set of infrastructure, a set of rails that can actually be better, faster, cheaper. I think that's why NASDAQ and whatnot, is interested, and why we're interested in bringing more funds on chain, because we want them to tap into global markets. We want them to be 24/7. We want settlement to be instant, and so we want to take a lot of that friction out. Think about all the costs of reconciliation and manual processes. A lot of these can be taken out of the equation when it's on an official source of truth. like a blockchain.
So this is part of the whole upgrade
It
of
is.
the financial system.
It is. So, I mean, you mentioned the volatility, and it's still an emerging industry and asset class. But I think you can get around that through position sizing, thinking about your time horizon, the role in a portfolio. Again, if sized appropriately, it can be a return enhancer. We've
Yeah,
seen that in the past.
the
It can be a
models have shown that.
diversifier.
The
Yeah.
models have shown, just having a 2 to 5% exposure over time can add value to a portfolio. But again, it can add volatility.
Yep, absolutely. And I think with volatility, it's always important to look at, is it correlated to other assets? Do they move the same way? And what we found with Bitcoin, and digital assets, kind of broadly speaking, is that they're not as correlated with traditional assets, right? So that volatility, if it's not as correlated, could actually help, with diversification. Again, if sized appropriately.
Now, right now, they're not very correlated because asset classes are down and crypto right now is down. Can you explain why the crypto market has come off so sharply off of its highs from last year?
Bitcoin reached a high in early October, just as we were kind of going into a general kind of risk off regime. So I think when we kind of peel back the onion here a little bit, we see kind of general macro drivers affecting digital assets, as well as some more industry specific. I think there was a lot of leverage in the system, in certain of these networks and applications. And, you had a lot of deleveraging there, right? As we moved into a more risk off regime. And I think, 10/10, October 10th was a day, it was the largest liquidation day in crypto's history. And that was the day that, President Trump said we're going to, put another 100% tariffs on Chinese, imports, right? So I think it's very sensitive to some of that, obviously with geopolitical risks and whatnot. There certainly is a macro overhang on all risk assets, and so digital assets get swept up into that. And then you had it exacerbated by some of that leverage that was in the system, which has since been cleared out. So I think the health kind of factor of the industry and these networks is a lot stronger now, and especially at these prices, than they were when we were quite elevated.
I've noticed there tends to be a cycle, which they call the crypto winter, which approximately every 4 years, you do see a sharp decline. Does that play into any of what we're seeing today?
It's certainly, people are aware of this, the halving or the 4-year cycle. This one doesn't seem to match up, perfectly like the others. This one is, I know, it's dangerous words in the investing world. This time is a little bit different. But it actually is. So I think there's a little bit of that. I think people did want to take, chips off the table.
Going into
Sure.
the halving, right?
Or even just here at year end, I think you had
You were up
some tax loss
tremendously.
harvesting going
Yeah.
on. So you had a variety of really drivers at play. What we can see from the on-chain data is a lot of people have held Bitcoin for quite a long time. They've been kind of distributing some of that wealth to newer market participants. So, that was kind of a trend that was evolving throughout the year.
I know it's hard to predict out, especially during times like this where there's a lot of uncertainty, but do you have an outlook for the crypto environment out maybe later into this year?
We're fairly constructive on kind of where we are now and kind of the outlook through the rest of the year. And I think that view is informed by, seeing a lot of that leverage kind of pulled out of the system. Within crypto, within digital assets, these assets are more correlated with each other. So you can have your favorite token out there, but if Bitcoin's not doing well, it is hard for that individual name or token to do well. And when we look at Bitcoin's price, it does seem to be more at, kind of support, kind of longer term support. So, you can think of it from an upside downside or a risk return standpoint at current levels. It seems that it's more skewed to the upside here. But then I think what gives us even more confidence, is just seeing, all the institutional involvement in the space and all the real world use cases being built, regulatory clarity, things like that, because that is what is going to help, accelerate this secular trend. So, if as long as you believe in the secular story, then these, bear markets are actually just better entry points, right?
Well, one of the philosophies we have in terms of investing in the equity market is called dollar cost averaging. It's hard to pick, the exact appropriate time to be buying, that you actually edge your way in over a period of time. Do you think that would be a good investment philosophy for somebody that's considering being in the crypto space?
Yeah, I think digital assets are no different. It's always hard to time the market, and so dollar cost averaging is tried and true.
There you go. So what are you most excited for going forward?
So I'm really excited about this continued convergence between traditional finance and decentralized finance. We see these two worlds as completely coming together, but you can almost imagine a Venn diagram, right? They're not on top of each other yet, but they're overlapping. And this space where they're overlapping is very interesting. So that's what's enabling. We're taking crypto native assets like the Bitcoin, Ethereum, Solana, and we're putting them in ETF wrappers, right? We're taking traditional assets like our money market fund, Benji, and we're tokenizing that and representing that on chain. And you're seeing a lot of real innovation at the intersection of these two worlds coming together. And I think you're going to see a lot more of it. With everything happening in oil markets and precious metals, we're actually seeing tokenized versions of those assets trade and represent pretty significant volumes on the weekend when other markets aren't open. So this continued convergence of these two worlds and the role that we as a global asset manager can play, both at this intersection and as these worlds come together, that's what really gets us excited. I think Sandy Call has this, I think, wonderful mental model of we're moving to from an account-based world to a digital wallet-enabled world. So right now, I've got a checking account, and a savings account, and an investment. They're all over the place, right? Different logins. But eventually, all these assets are just going to be represented in your digital wallet. That you own those assets, you take with you.
Spot.
Yeah, and your financial assets will be in there. You might have cultural assets in there, and the crypto native ones plus your traditional ones will all be represented in that digital wallet. And so that's kind of the world that we're moving to.
So that's where we're moving. When do you think that can actually take place? How long do you think that's going to take?
I think this gets back to, it's not going to be a straight line. Same with AI, right? These are exponential technologies. So we do think it will start to accelerate here. I think we'll see pretty meaningful progress in as early as, the next, 3 to 5 years.
So it really seems to be that innovation is everywhere. So we have innovation in financial instruments, in digital assets. We have it in AI, and we now have it going to the moon.
Yeah.
That we really seem to be in an advanced stage for technology. And I think this is very exciting for anybody that's younger and looking for different fields to go into, that technology is not dead, that it's going to continue to be, as your phrase, be more like that hockey stick, where we're just accelerating and accelerating at faster and faster paces. So we really covered a tremendous amount of ground here today. But is there something that we did not talk about that you think is important for our viewers and listeners to know?
Maybe just to circle back around to this idea of the ownership economy. So it's not just that we're all going digital, right? But there's a real way now to participate in these networks, and that is through ownership of a token and owning a piece of the network. So we think those digital property rights are going to be just ever important, as this kind of world evolves. It's not just that we're going digital, but that we actually have ownership in this kind of evolving protocol economy.
Well, Christopher, this has been digitally a terrific conversation, and I think one that is so needed for investors to really understand whether it's appropriate to be in their portfolio or not, because this is really the direction of where global economies are moving. So I want to thank you so much for joining us here today.
Well, thank you very much. Very fun for me, and a pleasure to be here.
And I want to thank all of you for tuning in as well.
Thank you for watching or listening to the Friends of Sanctuary podcast. Tune in next month to be sure not to miss out on the next installment of the series.
Securities offered through Sanctuary Securities, Inc., member FINRA SIPC. Advisory services offered through the SEC Registered Investment Advisors, Sanctuary Advisors LLC, and True Independence. Sanctuary Wealth consists of the wholly owned subsidiaries, Sanctuary Advisors LLC, Sanctuary Securities, Inc., and True Independence, as well as Sanctuary Alternative Holdings, Sanctuary Asset Management, Sanctuary Insurance Solutions, Sanctuary Global, and Sanctuary Global Family Office.